Hello, I'm Hagen Rogers with Watermark Advisors, and it's been a few months since we have talked about the M&A marketplace. So today, we'd like to give an update on the M&A market as we head into the end of 2022 and begin to think about 2023. So here we have overall year over year ending October 22 versus October 21 data. This is trailing 12 months for each year. Overall, the volume of M&A in the United States is down about 10%, okay? But what's really interesting is we look at the mid-market where Watermark serves clients, which is the $10 million to $250 million transaction. That market is actually down more than the overall of 10. It's down 15% in the mid-market. That's really interesting, and kind of similarly, as we look at valuations or purchase prices, the overall market is down 33%, 22 versus 21. However, only down 15% in the middle market. Very curious, why is that happening? Why is the middle market diverting from the overall market? I'm going to show you another data point that validates this and then talk about what is actually happening. So here we have private equity acquirers of transactions over the last several quarters going back to second quarter 2021. What we see here is a run-up in volume of transactions by private equity funds, the peak being in fourth quarter of 21, as we know that there was great concern about capital gains tax increasing. And then we have somewhat of a drop-off in volume in 22. However, the multiple paid for the transactions as a multiple of EBITDA have gone up by the third quarter to 8.1 times. Very curious what's going on. The takeaway is that there's really a flight to quality right now. That companies that are what I call, and you've heard me say over many years, metaphorically, an athlete is a company. Those companies are getting across the finish line of getting the deal closed. But companies that are less of the elite athlete and more of lesser than athlete, those that are great companies, but they don't have all the wherewithal to get through what may be choppy waters ahead, where there's more uncertainty into the future, those deals are not getting done, or they're not getting done to the terms at which the buyer and seller agree. I think that's what we see happening in the marketplace. So very interesting to take that. Let's move on to the next slide. And this is evidence that as the economy may worsen in 2023, and we do believe it very well could get into a worsening condition, that doesn't mean M&A is going to fall off a cliff. And this is really one of the main reasons why we said a couple of videos ago that the M&A market has decoupled from the economy. Not 100%, but substantially. The main key reason is that the corporate cash balances sitting on the balances of the big companies, here we have in blue S&P, Fortune, very large companies. Corporate cash is sitting not at the peak was in 2020 above 2.2 trillion, about almost 2.4. It has now dropped down to about 1.9 trillion. So as companies have paid off their debt and shareholder repurchases and invested in growth, what we're seeing here is tremendous levels historically of corporate cash. You can see we have really still very high levels of corporate cash available for acquisitions. Okay? This is also very interesting. This is the 2s-10s yield curve that is used to look at the bond market and how the bond market is looking at the overall conditions of the economy. So here, this is the 2-10s yield curve, and anytime it's above this thick black line, that's an indicator that we have an upwardly sloping yield curve, which means the bond market thinks the economy is fairly healthy or really healthy. When it goes below this black line, we have an inverted yield curve, and we have had that in 2022, and it is becoming more inverted. What does that mean? It means that 2-year yields are actually higher than 10-year yields. And what does that mean? It means that really there's less confidence by the bond market on what's ahead in the economy and financial performance of companies. And let's compare this to where we've been in the past. We go all the way back to the 1987 stock market crash here. Here we have the dot-com burst of 2001. Here is the Great Recession of 2008. And we're actually in a worse inverted yield curve now than these three pretty troubling times in our business market cycle. In fact, we haven't seen this steep of an inverted yield curve since way back into the early 1980s. Okay, so what does that mean for buyers and what does it mean for sellers? Our approach at Watermark is what we call the M&A bridge, which is that M&A done best is done in three phases: preparation, transaction, integration, both for buyer and seller. For buyer, our advice is really, it's all about strategy here in the preparation phase. Get really clear on why you need to do M&A. M&A is not a strategy, it's a tactic to execute when it's clear that M&A needs to be done, okay, to execute a strategy. As opposed to organic growth, M&A can be a good alternative. So here, we're saying whether you're doing M&A for R&D purposes, for growth, for product or market share growth, get very clear on why you need to do M&A. You need to make sure your core business is very healthy, and then get clear what we call commercial due diligence. What's your top market you need to acquire in and why? And then what type of acquisition do you need to make? What clear criteria will you have discipline around and not look at any deals other than those that fit into your criteria? And then move into approaching targets in the hopes that, knowing that what we said in a couple videos ago, that in the best performance of acquirers is when you acquire early in a recession. And that's clearly now. So the ability to get out of the preparation phase into the transaction phase when you have a live transaction is really key. But knowing why you even want to cross this bridge and doing it very thoughtfully is our best advice. Now let's move on to the seller. Same bridge again. And the advice is also strategy and timing. Here, we would say focus on the valuation. One of the methods of valuation is discounted cash flow. And in the DCF, what makes it unique as a method for valuation are projections. Building ground up projections based on reality of where you think the business is going to grow and go in the next 3 to 5 years. A base case would take into account the recession and how you will perform, how your company will perform in the recession. So really key, and I know that a lot of private companies don't go through year after year a really thoughtful, detailed, ground up, defendable projection analysis, but this is the time to do it and then put that into evaluation. And folks like myself can help you do that so that we can conclude, when we tie that back to strategy and milestones, how will your company perform over the next 3 to 5 years? That helps us conclude whether or not your company is an elite athlete. If it is, you may be able to time this and move on and go on across the bridge if that's been your interest in wanting to sell, but not sure about the timing. So in both cases, buyer and seller, know that the M&A market is definitely going to continue in 2023. But it's going to be about a flight to quality, and then therefore your decision making should be around these preparation steps centered on great strategy and timing. Thank you. We welcome any questions, and if we can help you with the preparation phase, please don't hesitate to give us a call at Watermark. Thank you.